This week, we're gonna talk about the price to be paid as investors. For some, it's just getting that money saved in the first place. Unfortunately, there are others you need to know about. So there's no way around it. Investing is tough. There is a price to be paid. It isn't pushing around the proverbial broom or plow, but there's still a price and effort that needs to be put forth. We want to talk about two things in particular that relate to the piece we're sharing from Ray Dalio. One is embracing volatility, understanding that volatility, again, is not risk. The second one is embracing new realities, new paradigms that exist, and understanding that, again, change is not risky. Sometimes it's not changing that's the risky thing. So what are we relating to today? Well, if you've had nothing but tech stocks and conservative bonds for the last decade, kudos to you for not being diversified. It's paid off in spades until the last few months. And so we've been, telling people, hey, look, things mean revert. This was admittedly a long run, particularly for some sectors of the stock market. It's also been an exceptionally long run from the bond market, which is the key to Ray Dalio's piece. And again, really going to be the point of emphasis again in this video. We've been warning you since last July. This is an area where there's going to be concerns. We've heard time and time again, people try to excuse it away. The reality is when you're going from where we were 30 years ago in the high single digits down to sub 1%, on a treasury, it's mathematically impossible to get that kind of drop in yields that is such a tailwind to total return and appreciation, let alone so many of those years where you could still get a 4 or 5% yield off your bonds. Now in a lot of cases, again, that's 1 to 2%. And yet people wouldn't change. Well, why wouldn't they change? Well, one of the reasons is, for that run, there hadn't been a lot of volatility in the bond market. It was a nice, smooth ride. And so going into things that might have a little bit more volatility, traditionally speaking, than fixed income in the form of treasuries or high quality bonds was scary. They viewed volatility as risk. And so what we looked at, again, about a year ago and talked about pretty openly with clients and even in these videos was, look, we're looking at the math here. It's all wrong. We know what's happened in the last 30 years. It just can't happen like that again for the next 30, at least from this point in time, which is all that really matters about is the play that's in front of us. And so we split things up. We looked at other alternative asset classes, other parts of fixed income markets that were different, short duration bonds, and we paid the price for it. To be clear, we had a little bit more volatility through March of last year than we would have had, but here we sit just a few months later, and now a year later, and in a much, much better place with an almost high single digit gap in what would have been the performance between those more traditional parts of the fixed income markets and where we're at today. Two key things to look at. One is we had to put up with a little bit more volatility to avoid what's become a permanent impairment of risk as we see it, or capital, excuse me. The second thing that we had to do is have great planning built for all of our clients, understanding how much within those short duration bonds do we need to have for unexpected expenses to afford us the right to go into some other things that, again, could have a little bit more volatility, but should do so much better for our clients over time. So just one example, again, of taking on a new mindset with respect to volatility and risk and understanding volatility can be lived through. Risk is really that thing that we're all afraid of. There we go. So the last thing we want to touch on is embracing change. Just like so many people equate volatility with risk, a lot of people equate change with risk, when what might be the riskier thing is not changing at all. You see this with a lot of sports teams that lose the second time to the team they beat the first time in the playoffs, and you hear coaches guard about it. But it's hard to win again. It's hard to know what to give up that worked that first time, or when your losses get shown to you, when your weaknesses get showed to you, you know how to evolve. And yet that's the challenge as investors that we need to overcome. Advisors too fall prey to this though, and for a few different reasons. Some are just quite frankly lazy. They're just trying to have as calm and easy of a career as they possibly can have. They don't want to continually be students of the game, evolve their practice forward. It's something that we challenge each other here at 10 Capital to do all the time. The second big thing is they're focused more on their own career, their own retirement than they are yours. It's an industry that's very old. A lot of people who, again, want to do it on their own, don't want to have to change, get focused on what's next for them, as opposed to what's best for the client. how do we take care of them? Pretty young group around here. We know, hey, if we don't keep taking care of our clients at the highest possible level, we're not going to get to have that chance to have that 20, 30-year career that we very much want to have. Lastly, and kind of related back to some of our earlier points, is just being risk adverse from an advisor's perspective. Just like it's easy to fall in love with past performance, it's also easy to try to justify why you're doing what you're doing based off past performance if you're sitting in our chair. And yet that again is a challenge that has to be overcome. For a lot of people, their traditional allocations have worked just great for the last 30 years. Talked about this week, Ray Dalio talks about below, why that bond component has a lot of concerns moving forward. So again, these are things to be on the lookout for. They're things we're certainly mindful of all the time here at 10 Capital to, again, remember and deliver on the number one principle that can never change, which is putting clients first. In closing, the thing we want to do is empower your plan. That unfortunately comes with a couple prices that need to be paid, but they're very survivable. One is understanding, again, that volatility is a price to be paid as an investor. Number two, that so too is evolving and continuing to change that allocation, change that approach when the circumstances call for it. It's difficult to pay those prices. It's why we're here, to walk alongside with you, explain it in as much detail as you have, but we wanted to, again, both call those out and let you know that we're committed to helping you overcome those as well as overcoming them internally ourselves. Thanks so much.